Hello, everybody, and welcome to the monthly market memo for the month ending August 2024. I'm Kay Seichenberger, the Chief Investment Officer with Retire Path Advisors. And in today's short video, we want to just recap a lot of the major market making headlines that you would have seen for the month of August and talk a little bit about for the outlook for the month of September and what may happen that will shape our financial markets. So without further ado, let's jump into it here for the month of August. Well, the August returns ended positive, albeit a very rocky start. We did see stocks fall, the S&P 500, fall by about 6% in just the first few days of trading in the month of August. However, if you fast forward to the end of August, when I'm recording this on August 30th, it appears that we'll see actually positive returns for the stock and bond market. And if you just didn't look at the beginning of August and are watching this today, you'll definitely should see some positive returns for your portfolio. So, what did happen that kind of shook markets there at the beginning of August? Well, we actually got the jobs report. The big reason for the sell-off was the release of the unemployment rate for the month of July, and that had coupled with the unemployment claims that were actually rising week over week at the end of July. So fears really, proved to be overblown. The unemployment rate went up from 4.1 to 4.3%. And the market really got some jitters on, is this going to be a recession or a start of a recession? However, again, fast forwarded to a few weeks later here at the end of August, and those jitters proved to be overblown as stocks have moved higher. Initial unemployment claims have actually come down and softened a little bit, which the market really liked. Additionally, we got some really good news on the U.S. consumer. You and I that make up this economy, we're about 70% of the United States economy, and the U.S. consumer still in really good shape. We are still going out there and spending dollars, which is translating to corporate profits and translating to higher GDP. The July retail sales number was a lot higher than expected, which was good for stocks. And also the Q2 GDP number was revised even higher from 2.8 to 3%. A lot of that was from the consumer being revised higher as well. So a lot of good news there regarding the U.S. consumer. And again, stocks really applauded those two reports and has really moved higher for the month of August after that rocky start that we saw at the beginning of August. Corporate earnings, always something we want to track here. That's really the reason why we invest in the long run, is to take part in the earnings of our mega cap companies. Mixed bag. We saw a lot of corporations that beat earnings. In fact, more on average beat analyst expectations of their earnings. However, the magnitude by which they were expected to beat by has been a little bit soft compared to history. And that really did result in some mixed bags for some companies. The big one reporting at the end of the month, this month, was NVIDIA, which again beat expectations, but the magnitude of their beats was a little lower, and the stock moved a little lower for that day, although still very much on a high note for the month of August. And then finally, what to watch for the month of September. Now, this is going to be a very important month as we start to get ready for the year end. And the month of September will, again, we'll look at the jobs report, which is set to come out on September 6th. That'll be the big number we want to watch for, is regarding unemployment. Again, last time it was at 4.3%. Will we see it go higher? Will we see it go lower? How many jobs will be created? What will be the wage growth of consumers out there? These are all things that the Federal Reserve is looking very closely at to see if they should be cutting rates, raising rates, or perhaps cutting rates more or less. Now, that brings us to a couple of charts and visuals I wanted to wrap up this call with, because this is going to be some important talking points for the month of September. Now, I just mentioned that the Federal Reserve is actually set to cut rates. We do believe that is going to be the case in September. And why is that? If you look at this chart here, you can see the blue line is the Federal Reserve funds rate, the rate that they set on overnight lending, essentially what you may get close to at your bank as far as a CD rate is, maybe a little higher than that, of course. You see it, started at very much a low bound at zero. COVID happened, right? Inflation picked up, which are the yellow and red lines. And then the blue line increased at the fastest rate we've seen it increase, which is the Fed funds rate. So at the end of the day, though, look where we're at right now. We're at the blue line, very much higher than the red and yellow lines, which are inflation, CPI inflation, PCE inflation. This means real rates, which are the Fed funds rate minus inflation, is very high. It's very restrictive, and it is set to come down. The Federal Reserve at the Jackson Hole meeting said inflation, albeit seems to be under control, and now they are worried about the unemployment rate. So we have to look for the next move for the Fed funds rate to be a reduction of about 25 basis points. That's what we're showing here on this next chart, is what are the odds of either a 25 basis point cut or a 50 basis point cut. And it's about, as of yesterday, about 66% of the market expects a 25 basis point. However, there are some people that are expecting a 50 basis point cut. And I think that's going to be real key to what's going to cause maybe volatility here in September, is when they meet on September 18th, after they see that jobs number, how much will they cut by, and what should we expect the Fed funds rate to be. Also, going towards the year end is very important. Now, we started this year, this is the chart I want to show you, is how many cuts were expected throughout 2024 as we go through time here. And as you see the line move, the lower it is, the more cuts are expected. It really started the year around 6 or 7, which was very optimistic for the year. We started to get some inflation numbers that were actually above expectations. Then kind of around April, May, the end of spring, start of summer, we started to see inflation numbers get soft. And that's when you started to see rate cuts be more priced into the market. Now we're ending this, at the time of this recording, about 4 rate cuts expected by year end. Now, there's only 3 Fed meetings left, and one actually happens right after the election day. So we will be very much watching this number. It could go back down, if you will, to 3 cuts. Obviously, if we get a lot of soft unemployment, it could accelerate to more cuts happening, or more larger cuts happening. Something here at Retire Path we're watching very closely. And then finally, I wanted to wrap up this call and talk about a little bit about, what's the market expecting after the Fed cuts. That's kind of the next question, is once the Fed starts to cut rates, what happens to the market? From research that we looked at, we noticed that on average, stocks still do better 1 year later after cuts happen. Actually, core bonds do pretty well. And if you notice this number, all 3 of those categories, stocks, government bonds, corporate bonds, beat cash 1 year later after cuts start to happen. However, it's going to be very path dependent on the economy. If we do see no recession, quote unquote, a soft landing, you should expect stocks to do very well. And you should actually see bonds do fine, but not as well as they may do if we see that recession. Cash can still add value, of course, as long as the Fed is not cutting fast and by large amounts. However, that may happen if you do see that recession number come out, of the unemployment number go up. Therefore, you expect to see bigger cuts, and bonds do a lot better than cash. And actually, if you notice that red number there at a recession, stocks still do pretty well. Again, this is 1 year later. So at the end of the day, inflation easing should mean the Fed looking to cut, and that's what we expect for September. So thank you for watching this video, and thank you for your trust. We do approach the management of your complete financial landscape very seriously. As a trusted steward, advocate, and confidant, we are committed to you. Please reach out to us with any questions. As always, email us, call us on the number here, find us on the website. Of course, reach out to your personal Retire Path advisor with any questions you have, and I'm always happy to speak to you as well. Thanks again. We hope you had a great Labor Day and have a great summer. Thank you.